So despite the mini stock market rally this week, it very much appears like the worst is yet to come for investors. UK inflation rates have risen to well over 9%, and the Fed has recently raised their interest rates by 75 basis points to combat their equally high levels of inflation. And it's likely that the Bank of England will also follow suit and hike interest rates next week. And whilst this is all an attempt to curb the levels of inflation in the short term, it's certainly going to make the cost of living crisis worse for everyone. The Bank of England governor even recognises it himself.
And I must say that I recognise the hardship this will cause for many people in the UK, particularly those on the lowest incomes, often with little or no savings, who are hit hardest by increases in the prices of basic necessities like food and energy.
So with further hardship and a cost of living crisis, we're now entering into a new era of investing, which many of us have probably never seen within our lifetimes before. So let's talk about it and how it could affect us, our money and our investments. But before I do so, guys, my name is Mitch. I post all kinds of videos on investing and the stock market. If you do enjoy content like that, hit that big red subscribe button down below. Drop a like on the video, guys. Really helps out the channel. With that being said, let's begin. So to put it simply, here is how it's going to play out. With inflation rising, the cost of goods are becoming more expensive. I'm absolutely outraged that the price of a Freddo bar is now 30 pence. That's over a 200% increase since the early noughties. And whilst I certainly joke, this is exactly the problem that we have, but on a far bigger scale. The price of meats and poultry is up 38%, milk is up 42%, and potatoes are up 121%, and that's just since the beginning of 2021. So you can see just how insane the price of a normal basket of goods is, which is the so-called benchmark for the 9.4% inflation rate, or so we're led to believe anyway. And that's before we even start to begin the topic of energy prices and the potential for the energy price cap to rise to over £3,500 in October, which is 65% higher than what it was before.
Oh damn!
So with inflation running rampant and with forecasts suggesting that it could rise to upwards of 10 to 11% by the end of the year, the Bank of England have had to step in and inevitably hike interest rates. Why, you may ask? Because it stops people from spending money because money is more expensive to borrow, which means businesses start to earn less revenue. They then start to cut back on expenses and start to make people unemployed, which then inevitably goes on to result in 2 consecutive quarters of negative GDP growth, also known as a recession. And this is a recession that everybody's talking about, which is forecasted to hit us in 2023.
That the UK will face an effective recession towards the end of this year.
Now, although some analysts already believe that we're actually in a recession based on the environment which we're facing into, it's certainly not yet coming through in the data, or so we're led to believe anyway. And I think this is what makes all of this 10 times worse. The fact that people are already feeling pain in their finances currently. And if you think roll on another 6 to 9 months of high levels of inflation, plus the potential for a recession and greater levels of unemployment, that's only going to create a hell of a lot more pain for individuals and their financial situations, not just now, but into the future as well. It's a reason why interest rates are going up so rapidly at the minute, because it's going to hopefully ease some of the long-term pain for all of us. Because according to future forecasts done by PwC, inflation should stabilise around the Bank of England target inflation rate of about 2%, by Q4 2024. So without being the bearer of bad news, it's certainly not looking great for us in the next couple of years. But how on earth could this affect our investments? Well, inflation, on the surface of things, isn't always terrible for equities, especially those which have something called pricing power. It's why you've seen companies like Apple in their most recent quarterly earnings report record a beat on both profit as well as revenue, and they're also expecting further growth too. And even when we look at this from a broader stock market perspective, higher levels of inflation don't necessarily correlate to negative stock market returns. And I certainly think that that's a very important distinction to make. Just because the broader messaging within the media is full of doom and gloom doesn't necessarily go to say that stock market returns will be just as bad. Which of course is difficult for me to say as of right now, because stock market returns haven't exactly been fantastic during the first part of this year, due to the fact that they've been somewhat shook from the broader macroeconomic environment. But when we actually look at the data between 1928 and 2020, you can see we had really high inflation in the late 70s and the early 80s, when it was as high as it is now, and stock market returns were still positive during that period. Yes, we had a couple of years of negative returns, but nothing too serious and nothing too long lasting. Now you might be thinking, well, let's park inflation because that's one thing. How about the impact of higher levels of interest rates on the stock market? Because for the most part, you'd probably expect to hear that higher levels of interest rates is bad for stock market returns, which would certainly be fair to assume, because when interest rates rise, money becomes more expensive to borrow, and all of the promising growth stocks that we're all investing into all of a sudden find that money more expensive, and therefore they can't borrow as much and invest that money back into the business in order to facilitate future growth, and as a result, profits become lower, and therefore their stock prices go on to fall. And whilst that certainly might be the case for more aggressive growth stocks, it's certainly not quite the case for the broader stock market, because in actual fact, during the past 5 rate hike cycles, 4 of those cycles resulted in a period of positive returns for stock market investors. And I guess this is where there is so much appeal for me personally to just simply invest into a broader stock market index tracker like the Vanguard VUSA S&P 500 ETF. But aside from that, in this rather challenging macroeconomic environment that we're in, there will certainly be opportunities for those of you guys who are prepared. And as a result, there will be very much winners and losers over the course of the next couple of years as all of this plays out. So because of that, I wanted to share with you guys how you could put yourself on the winning side of the formula. But aside from that, I wanted to discuss who will be the individuals that will lose out the most from this current environment, starting with the individuals that unfortunately have low household incomes. I saw an article the other day that said the average savings rate in one of the major UK banks was just £500 per person. That's super thin on the ground when you consider the high inflationary climate we're in right now, and it certainly doesn't leave much scope to tackle those higher levels of inflation without going into some kind of financial difficulty. It's also the reason why bad debt is also starting to now rise, along with big major banks actually setting aside hundreds of millions of pounds in provisions because they're expecting a hell of a lot of loan defaults. Now on top of that, the other big losers unfortunately in this environment will be first time buyers. Home prices here in the UK have absolutely shot to record highs and are now roughly around £300,000 on average. And that's certainly thanks to a period of consecutive double-digit growth rates in the past couple of years. And as such, it's almost priced many first time buyers out of the market. And that's even before we start to consider the impact of higher interest rates affecting monthly mortgage repayments. Because let's say you're a first time buyer who managed to buy the average price of a house at £300,000, you put your 10% deposit down and you had a £270,000 mortgage. Well, a couple of years ago, where interest rates were super low, you could probably get an interest rate on your mortgage or in and around 1.2%, which would have resulted in monthly mortgage payments of about £1,000 per month. Now, that very same mortgage in today's climate, with interest rates in and around the realms of about 2.5%, your monthly mortgage repayments would jump to £1,200. That's a 20% increase, and for those who have very little to no savings whatsoever, certainly could potentially leave them in a very sticky financial situation. But then on the flip side, whenever we kind of see adverse and challenging market conditions, there will always be opportunities for those who are most prepared to take them. And as a result, when there are losers, there are also winners too. With the first winners in this kind of environment being savers. If you're one of those individuals that's great at saving money, well, at least now you'll be getting a little bit more than the 0.01% interest that you've had on your bank account probably for the last 10 years. With now major high street banks increasing the interest rates which they're paying on savings accounts, with banks like Chase offering a 1.5% interest rate on all of their savings. Which you might still say, well, yes, but you're still losing your purchasing power every single year thanks to inflation, but I guess something is better than nothing. Now, to coincide with that, those who have been in a position to be able to save more money will also be able to take advantage of deploying cash into the market during a recessionary period. Because during difficult times, there will be opportunities to deploy that cash into the market for an ever greater return on investment. For example, when people unfortunately start to default on mortgages and those homes go into repossession, there will be opportunities for those who are sat cash heavy to pick up those houses at a wildly discounted price. And on a similar note, even during periods of time when the stock market is falling down in value, almost like we've seen during the first part of this year, even if the stock market continues to fall down in value in the next 3, 6 or 9 months as all of these inflationary fears start to play out, if you can start to deploy some of that extra cash into your investment portfolio, in the long term, you'll only ever see greater returns on your money. And that certainly might sound quite predatory, but it certainly is just the fact of life. So I think if this situation is going to teach us anything, it's to financially empower ourselves to be in a position where we're the ones that capitalize on any kind of adverse market opportunities that present themselves in order to generate a huge amount of wealth over the course of the long term. For me personally, I won't be deviating from my overall investment strategy. I'll still be continuing to cost average into the market every single month, and I'll continue to share that with you guys. And perhaps when there are additional opportunities, then perhaps I'll deploy a little bit extra cash as and when I see fit. So with that said, guys, I hope you found this video useful. If you did so, be sure to drop a like on it. But before you go, guys, if you do want to see what I'm personally investing into as of right now, then be sure to click on this video here. And with that being said, I'll see you over in the next one.